If you own an LLC and finally start making money, this video can save you thousands and potentially keep the IRS away. Most people rush to form an LLC because they hear about tax savings and protection, but the moment the money hit their bank account, one question completely stops them cold. How do I actually pay myself? Here's the scary part. There's a right way to do it and a wrong way to do it. Get it wrong and you can destroy your cash flow or pay more in taxes. Or even worse, accidentally pierce your protection that the LLC provides. So if you're new to business or have an existing business making money and want to make sure you pay yourself correctly, make sure to watch this entire video. Because at the end, I'm going to explain when you might need to change your LLC structure. Welcome back to the channel and let's get started. How LLC owners pay themselves. The first thing you need to understand is this. If you are an owner of an LLC, you do not pay yourself like a normal employee. Instead, most LLC owners pay themselves using something called an owner's draw, also known as an owner's distribution. An owner's draw is when you take money out of your business account and transfer it to your personal account to use it for personal expenses. This is extremely important. The business finances and personal finance should never mix. Mixing business and personal fund is called commingling, and it's one of the fastest ways to fail an IRS audit. An owner's draw exists to prevent the exact problem. Think of it this way. A business bank account is only for business purposes, while a personal bank account is only for personal purposes. So an owner's draw is simply the bridge between the two. Now let's walk through how to set up an owner's draw the right way. First, you need to go and open a business bank account. Your LLC needs its own bank account. Take your EIN and take it to a bank and open a checking account. All income earned by the business should be deposited into your business bank account and not your personal bank account. This keeps your books clean and protect your LLC structure. Now let's take a look at the owner's draw. Once your business starts making money and you're ready to pay yourself, you need to transfer money from your business account to your personal account. You can do this by making a bank transfer or a check. I strongly recommend avoiding cash whenever possible so you can have a clean paper trail. You also need to record each draw date and the amount and the purpose for bookkeeping records. You do not need to pay yourself a salary as an LLC owner. And here's where most LLC owners get confused. An LLC is taxed as a sole proprietor or partnership. You do not have to pay yourself a fixed salary. There is no paycheck schedule. There is no required amount. You decide how often and how much to pay yourself. Some months you might take more, and other months you might leave more in a business. That type of flexibility is one of the benefits of an LLC. One of the biggest mistakes I see is new LLC owners taking too much money too quickly. When your business starts making money, it's exciting. I get it. But you must leave enough money in the business to cover expenses and taxes. Remember this, as a self-employed individual, you owe about 15.2% self-employment tax on top of your regular income tax. That 13.3% covers Social Security and Medicare, and if you forget to plan for taxes, you will probably feel it later. Never drain your business account to zero. Unexpected expense always pop up, such as new software, advertising, equipment, repairs, so it's always best to leave a little bit of breathing room. Now, let's go over taxes and LLC profits. LLC are considered a pass-through entity. This means that profits pass through the business onto you personally as a business owner. The IRS taxes your profit whether the money stays in your business or move out of your business to your personal account. So Uncle Sam always gets paid. The benefit is that there's no double taxation. Your business profits are taxed once and not twice. LLC and liability protection. One final reminder that your LLC provides limited liability protection. That means if your business gets sued, only your business assets are typically at risk, not your personal asset. But the protection only works if you respect the structure. And you can start with separate bank account, clean record, and no commingling. If you ignore these rules, you can be sued for your personal assets. Now, let's go over when you should consider an S corp. As your business grows, your self-employment taxes will only get bigger. And that's why many LLC owners eventually elect to file as an S corp. An S corp changes how a business owner pays themselves and can significantly reduce their self-employment tax when done correctly. That's something to consider if your business makes more than $50,000 in profit per year. If you find this video helpful, make sure to like and subscribe and share with a friend. And don't forget, if you need help with bookkeeping or accounting services or tax preparation, click the link in bio for a free consultation. Thank you. I'm Andy, and see you next time.